G'day guys, I just wanted to give you a quick perspective on gold because there is still a lot of things being written and being said about whether the gold bull market is finally finished. And there was a pretty good piece written in the Eureka report through the week where a guy from, I think it's Cavell Research, which are a pretty respected firm, provided some explanation as to why the gold price has stalled. But from my perspective, I'm more interested in the price of gold producers more than the price of gold, which is what I tend to trade. So really I'm looking at this from the perspective of what impact will it have on the price of gold shares. So just a quick reminder, general advice only here. So this is the argument that was put forward in this report. China and India account for 41% of global gold demand. That demand fell 3% in India in the recent period, and that's due to a number of factors. Credit growth is slowing in India, interest rates are rising, there is a degree of political uncertainty. They've tried to whack on a tax surcharge on gold purchases, which may or may not be rescinded, and also the currency is under pressure as well. So there's quite a few things that are impacting gold demand in India. When you look at China, China has more alternative investments available to them now. The locals previously were restricted to local share and property investments and gold. That should say and gold. What the Chinese government is doing at the moment is loosening the capital controls to try and curb some of the corruption there, and that has opened up foreign real estate and foreign equities as potential investments, which then kind of takes the focus off gold, which has been strongly promoted to the retail public in China. So the bottom line is that that's really good for stocks and commodities, because if there's more money now coming out of China looking for a home, and we've certainly seen a lot of apartment buying from Chinese in Sydney and Melbourne. So that's positive for stocks, for potentially real estate, and also for commodity prices. However, it's not all that flash necessarily for gold. But the question I pose is, what is all the impact of this on the actual price of gold shares? So where to from here? The first question I really want to ask, and I've got to stress that I don't think anyone knows the answer to these questions. It's a very dynamic situation. Those demand figures for China and India could turn around again. Just because that's where they've been of late doesn't mean that's where they have to stay. So no one really knows, but let me just ponder a couple of questions. Has the debasement of currency by money printing by the US, China, Japan, Europe, England, has that stopped? And the answer to that quite clearly is absolutely not. And over the long term, as currencies continue to have their value debased, then people are going to increasingly turn to gold. Secondly, has the price of gold been artificially manipulated down to a lower level than what it otherwise would be? And again, I think overwhelmingly the answer to that question is yes, it has. So even if demand comes off in China and India, eventually I believe that free market forces do prevail in the end, and that this manipulation will be overcome. But the real question is, what will happen to the price of gold producers even if gold stays where it is? Let's say it stays between $1,500 and $1,700 an ounce for an extended period of time because of all these influences. What does that mean to the price of gold producers? So I look at it over the long term from a value point of view, just like you'd value any other business. So I look at it from, and there's a number of ways you can value gold. You can use discounted cash flows and all sorts of fancy mathematical analysis. But I just strip it back to a couple of really simple relative questions. One is I look at the amount of realistically recoverable gold that's in the ground at the moment. And to calculate that, I take 100% of the reserves, which is pretty much a known. That's a very high probability figure. I take 40% of the resources, which is not as higher probability deposit, and I take 10% if the company quotes a possible figure, in other words gold that they think might be there. So that gives me a number. I then calculate the net profit given the company's current cash costs of production. So if their cash costs of production are $700 an ounce and gold's at $1,700 an ounce, then we've got $1,000 net profit margin. I then take half of that figure, so I'm being as conservative as I possibly can be. So I'm being very conservative on first of all establishing how much gold is possibly in the ground. I then say, well, they might only get half of that out. So calculate the net profit based on that current gold price, and then I compare that to the market cap of the stock. And what I'm finding at the moment is that in a number of situations, the market cap is only a half to a third of that extremely conservative recoverable gold in the ground. So if I'm looking at this purely as a business investment, I can buy gold in the ground, recoverable gold in the ground, for less than half or less than a third of the current gold price. Now that, whichever any way you stretch it, seems like a good deal to me. If you can buy $1 for 30 cents, then I'll do that any day of the week. The other way that I look at it is to just consider it from a PE ratio point of view, and there's some holes in using price earnings multiple, but it's a yardstick. And if I can buy a high quality gold producer, and I stress high quality gold producer, so I'm talking substantial reserves, long mine life, good grades, no debt, cash costs of production under control, plenty of blue sky potential. So I'm talking a quality gold producer here. If I can buy that for less than 8 times price earnings ratio, then I think over the long term I'm getting a good deal, particularly if that production profile is rising strongly, as it is with some Australian gold producers. So ultimately, in my view, the share price will ultimately reflect the value of that business. So to my mind, whilst there are there's some good things being said and written that are worth thinking about, there's some stupid things being said and written that aren't worth thinking about, but I still believe very, very strongly as a medium to longer term investment, the case for buying high quality gold producers, buying them when they're cheap, and just ultimately letting the share price reflect that value. So that's it. Just thought I'd share that perspective with you. Cheers.